Hello everyone, welcome to the video. We got to talk about a few changes to what I'm looking for in investing and all this fun stuff like that. So for those of you guys who do not know, this is both a learning for both of us, both myself and you, and also documenting what I'm doing, my investing, my strategy and everything like that, and just seeing where we go from here. So, hopefully it's like if I ever do become a millionaire, which my goal is eventually a millionaire status, we'll see the progress I make and the mistakes I make going to get there. So this is the portfolio as of right now. You have Allied, I'm just going to go over the ticker, AP.UN 9, card CJ 6.9, DE 6.1, NET 11.1, O 8.5, TGIF 12.8, and PDI at 50. And I don't know why it's all mixed up. I have to redo it eventually one day. But here we go. This is everything right here. You guys can literally see the shares, the price I bought it at, and all that fun stuff. Now, looking at this, you're going to realize there's no covered calls anymore. HMAX is gone. Where did everything go? Why is all the covered calls gone? The simple answer is, as much as I love covered calls and they offer a huge yield, I'm slowly seeing a pattern of them getting a little bit unstable. When volatility spikes and it's huge, they generate large amounts of income. But when it dies off, because of a bear market, recession, people doing their absolute best, basically choosing, do I invest? Do I save in case I get fired? Or do I put food on the table? Investing is the last thing on their mind. So I think covered calls going forward are going to slowly start to decrease the dividend, especially for companies and fund managers that don't have good risk management. A fantastic example, and I am going to crap on them, and I'm sorry again because I do this every single video, is Hamilton. They just released this fund, div cut 2.7%. HYLD, oh, we didn't expect them to have a div cut, dividend cut. But then if you look at something like Purpose, look at that. You got a dividend hike. There's no cut yet. There hasn't been a cut at all. Oh, but their new Tesla one definitely does. No, not a single div cut. But then if we look at a more aggressive, less risk management approach to Tesla, div cut, div cut, div cut, 50%, almost 50%. Do you see a pattern here? A lot of these fund managers have gotten so lazy, they don't bother doing risk management. So that is affecting their ability to generate income. Now, TSLY screamed it was a yield trap / a gamble and everything like that. And people who have promoted this should absolutely be shunned. I'm not even kidding when I say that. They literally sucked you in to a crappy ETF. I'm sorry. I'm just saying it how it is. I don't care if Tesla moons, they'll generate more. This shows how no risk they have. Dude, this fund could implode tomorrow and people would be like, are you surprised? But I'm not saying it's going to implode. I'm just jokingly saying that's how bad the risk management is. But if we go over here, we can go over what every single one of these are paying you because they're consistent income. Rent, oil, yes, is variety, so that's why I'm kind of iffy on it. Income from multiple industrial sectors globally. Rent, interest from bonds, interest from loans, bonds, ABSs, mortgages, CMBSs, etc., etc. And the joy of this is that we can literally predict what the income will be because it hasn't changed. It hasn't changed. PIMCO owned Credit Suisse bonds and stock. Silicon Valley, I believe it was just the stock, but I could be wrong. And I want to say First Republic as well. And they've lost 3% of their income for the entire year. They're still making profit. Their UNII, the undistributed net investment income. This is when you take your net investment income and you subtract it from the dividend, is 72%. That's they have to lose a huge amount more cash for them to even feel the pain of it. And a high UNI, a high U sorry, oh my god, a high UNII means they have more cash on hand to pay special dividend, to increase the NAV, to do all this different stuff with it. And because HYLD has been negative cash flow, guess what they probably have had to do? They probably had to sell stock. They probably had to do all this different stuff because they're probably burning themselves trying to pay the dividend. And they're like, well, finally, we can't do it, guys. We have to cut the dividend. What's stopping them from cutting it again? They have a horrible track record so far. So they could just cut and cut and cut and cut. That could be the next Orchard Capital. PIMCO, though, because it's reliable income, can be like, here's our income coming in. Here's our distribution. Oh, yeah, we have a 72% gap between the dividend, well, the cash we have left over, and the dividend we pay. So it's so much safer. And I've had this conversation with so many people on Blossom, and it blows my mind how, and no offense, stupid these people are. Well, PIMCO is only good if you bought it in 2012 when it came out. No, it's not. What are you talking about? They're paying consistent income, and me buying it close to the very bottom of where it was at $17.29 has given me a 7.85% return with only one dividend included. One dividend. Now, if we get rid of the dividend, wow, it's 6.77%. I already have stock appreciation and 1% plus gains every single month from the dividend payment. Oh, but TGIF is the exact same. Okay, fair. It's the exact same, but it's reliable payments. That is the biggest difference between me and people like passive income investing. And there's another like larger covered call Canadian guy. I don't really know his name right now. That's the biggest difference between us. They care about, I want high yield now. I'm like, I don't care what the yield is. Is it safe monthly income? Is it safe income regardless when they pay? That's why I'm looking to use TGIF to buy to buy Newport Exploration, NWX, because the payout was very unstable to, it's 74% payout ratio. Great. They'll probably eventually bring back the 2-cent dividend in a massive bull market. So I'm more than happy to wait around and see what will happen. But till then, until this bear market and everything calms down, I'm avoiding covered calls. The only company I'm even remotely holding right now, like their funds, is Purpose, because they've shown time and time again they have good risk management and they're reliable for income. So that is what's happening right now. This is why you don't see any covered call at all in here. And genuinely, this is probably what we're going to stick with. We're going to stick with small to large cap, and then funds that use no or very little covered call. So I just wanted to put this out there. This is what I'm going for in the future, and this is what's happening going forward. Again, if you buy covered calls, no hate, but I am a little bit scared of a few fund managers, and I'm scared that as this recession gets worse and worse and worse, and as credit card and debt get worse and worse and worse globally, people are going to be spending less and less money buying options and gambling their money away. So that's why I would rather have, TGIF, it's bonds. Companies have to pay bonds, and they have to issue bonds to get that liquidity. PIMCO, loans are always going to be a thing. Mortgages are always going to be a thing. Bonds are always going to be a thing. Asset-backed securities are always going to be a thing. They're always going to be demand where they are not going to be struggling to find high-yielding instruments to keep the yield and dividend up. But then for all this other ones that use covered calls, the moment they don't get a high premium, negative cash flow for 1 month, whatever. A few months later, we had to cut the dividend. That's a little scary to think about. And it also shows just how fine managers are lying to your face. Again, go watch Passive Income Investing's interview with Hamilton if you want to see a guy desperately trying to be like, stay with us, we need your money. But you guys choose what you want to do. I saw some of it. My friend sent me clips of it, and I am not touching that thing. I do not trust that guy. I'm sorry. Purpose, iffy on. The yield max stuff, I'm not touching with a 10-foot pole. I'd rather buy Purpose's version because it's just much safer. But yeah, guys, that's pretty much it. Have yourself a good one. Bye.